And good evening, good afternoon, and good morning, ladies and gentlemen. My name is Dr. Greg McLeod. Welcome to another edition of Bulls versus Bears, the weekly Forex forecast. And this is where you get my insights into what's going on in the markets for this coming week. Okay, I'm going to go ahead and share my screen. Hope you guys are having a great weekend. We're going to go ahead and get started, and I'm going to share my screen. And again, this is brought to you by the Elite Traders University. Elite Traders University, we help traders become professional traders in 90 days or less using my proprietary system. Go to www.elitetradersuniversity.com. Okay. Bulls versus Bears for this week, the week beginning the last week of August, for the August 27th, 2023. Okay. Before we get started, I want to direct your attention to the risk disclosure on your screen to make sure you understand all the risks associated with foreign exchange trading. And I've been teaching and training people for over 28 years. I worked at one of the world's largest forex broker dealers in the world. As a currency analyst, strategist, and trader coach. And I've traded everything from silver, gold, crypto, oil, and of course, forex. And I'm uniquely qualified to instruct you and to teach you because I've worked for the big guys, the Wall Street firms, and a lot of my articles are still being used to train professional traders in these various firms. And so I'm going ahead and share those insights with you and be your mentor, your coach to help you reach new levels in your trading if you choose to. Okay. So let's go ahead and get into our agenda. We're going to look at the dollar index, euro, dollar, pound, dollar, the Aussie dollar, the majors, dollar, yen, and dollar CAD. Then we'll take a look at the maybe gold, S&P 500, and we're going to start with the economic calendar. I'm going to switch over to one of my favorite tools I like using is my market heat map. It's arrangement of currency pairs by percentage change. We're going to share screen one, right? Let's go ahead and do that and share. Okay. So this is my market heat map. It's an arrangement of currency pairs by percentage change. Is one of the tools, but it's like a Swiss Army knife. You see those Swiss Army knives. They have a spoon and a fork and a knife and a compass and all kinds of things and flint, so you can light it. You can create a campfire. It's that all-purpose tool. I took my favorite tools and put them together and had the heat map program. And so these tiles actually change colors and start moving when the market is moving. Because right now it's Saturday. And there's also this economic calendar, which we're going to focus on as well, that you can access for free. Let's go to mymarketheatmap.com to get access for it for free. Or if you would like to have premium access, it's just $50 for the month. Okay. Let me go ahead and go into our heat map. I've already signed in. And we're going to take a look at the economic calendar. The reason why I start the economic calendar is because that is the volatility that news creates is what creates profit in the markets. And by looking at the flags, we can kind of know what to trade. And also looking at how impactful those news items are. High impact items usually cause more pip movements in the various currency pairs, and lower impact items will have less impact on those currency pairs and provide less trading opportunities. So we want to make sure that I go ahead and I preset that I filtered out all the medium, the low, and the none. I only want to look at the highs. I only want to look at the G7 or G8 currencies, including the big dogs. And I say that way I can screen all those out. And that's what we're going to talk about. Now, notice it starts off. You might be asking, well, Greg, where's Monday? Well, Monday, there's no high impact news. And usually if you want to trade Mondays, I don't necessarily trade Mondays that often. But usually if there's no news, then the currencies that or other instruments you're trying to trade will probably respect typical support and resistance levels, basically a ranging market until we get some high impact news to really drive things up. Okay. So we look at the flag we see on Tuesday, August 29th. We're going to have our first high impact news item. It's going to be the euro. We have not the euro flag, but we actually have the German flag. And Germany is one of the largest economies in the Eurozone. And we can see that it's a GfK consumer confidence. It's going to come out at 2 a.m., maybe a little early for you guys. and but it's supposed to basically remain flat, negative 24.4, negative 24.3. And so it might not have very much impact if there's not a change between previous and forecasts. Usually if we get a surprise, that's what usually drives the currency, right? But at 10 a.m. we're going to have the USD JOLT job openings, and that's supposed to actually drop from 9.58 to 9.57. And when I see the American flag, I actually like trading the euro because the euro is the anti-dollar. So if it's dollar positive, it's going to be euro negative. And so since the euro is the anti-dollar, it's one of the currencies with the highest amount of volume and people interested in it, I'm going to look at the euro when I see the American flag. Okay, that's my only caveat there. And since we're already looking at the German consumer confidence, you can see there's probably going to be a lot of interest in the euro coming up on Tuesday, Monday and Tuesday. Okay. And then we're going to have CB Consumer Confidence Conference Board. CB stands for Conference Board, not Breaker 19, Babe Rubber Duck. No, it's a CB stands for Conference Board Consumer Confidence. And it's supposed to, we're looking at that, actually dropping from 117 to 116. High impact item at 10 a.m. Normally it's an 8:30 a.m. Eastern time news. That's another news cycle that we'll see. But apparently there's no high impact item there, but currency is still like moving at 8:30 a.m. At 9:30 p.m. at evening, we're going to have the monthly CPI indicator of Australia. And CPI stands for Consumer Price Index. But remember, when I see an I think of inflation. So they're measuring inflation. And they're looking at a drop from 5.4% to 5.2% in light of all the rate hikes that's been going on. Maybe they're starting to have some impact. And it's basically said that extended interest rates usually take about 6 months for them to kick in. And then after a rate hiking cycle, there's usually a rate cutting cycle. Okay, so we'll see if that's the case now. Tomorrow or the day after that, Wednesday, August 30th, we're looking at the Eurozone inflation rate year on year. That's not yo, hey, yo, boy, yo. No, it's not yo. It's year on year or year compared to the previous year. And we're looking at that inflation rate for Germany dropping from 6.2% to 6%. So it's moving in the right direction. And then at 8:15 a.m., we'll see ADP employment change as we get closer to that all important non-farm payroll announcement that comes out the Friday. The first Friday of every month is non-farm payroll, so it is non-farm payroll week, and so that'll be an interesting to see how the markets. Sometimes the markets will range, move sideways between Monday and the non-farm payroll release, the release of the U.S. jobs number, which is called non-farm payroll, released on Friday at 8:30. And that's a very important event to watch. ADP used to come out on Thursday, and usually it is, since it's a private company and they print paychecks, and we can tell how many paychecks they actually create to know how many jobs are created, which is pretty simple, right? But they don't count they don't count government jobs or public service jobs, so it can be a little bit skewed. The previous number was 324,000, and they're looking for the number to fall to 195,000. That's one of the impacts of higher interest rates. They reduce job growth and job creation. Okay. When no one has a job, they can't buy stuff, right? And if they can't buy stuff, prices fall, and that reduces inflation. So it comes at a cost. At 9:30 p.m., we have some Chinese data, NBS manufacturing PMI. PMI stands for Purchasing Managers Index. We're looking for a rise from 49.3 to 49.5. He said, well, Greg, we don't trade the Chinese renminbi or the yuan, the other name for the Chinese currency. And I say, yeah, we don't. However, Australia and New Zealand do, and we do trade the Australian and New Zealand dollar. And since China is their largest trading partner, we can actually trade this information of China using the New Zealand dollar and the Australian dollar as a proxy. Okay, and proxy means that if the Chinese economy is growing, then Australia and New Zealand usually grows too because they're selling to this big economy. However, if China's economy slows down or they catching a cold, well, then New Zealand and Australia will catch a flu, right? Because their biggest partner is not doing so well. Recently, Australia and New Zealand have not been doing so well because China has not been doing so well. Okay, so hopefully, if by being part of mentorship and getting into relationship with my company, with me, you'll get to learn these kinds of things. Well, Greg, someone just recently asked me this on a messenger. They said, well, Greg, which school did you go to learn this? And I said, well, I spent probably over $200,000 in my education. I have books, tapes, CDs, DVDs, tickets to different types of events and workshops and money shows, all over the country that I went and used and spent and invested in order to gain my education. So there was not one school I went to. I didn't go to like a business school to learn this because business schools don't really teach this. There are a handful of schools that actually teach stock trading, that you get a major in it. But you have to be at the master's level to actually receive any type of certification or conveyance of a degree that states that you can trade stocks, right? And those degrees, it costs anywhere between $35,000 to $100,000 a year to be part of. So in light of that, that's why I created Elite Traders University. No, we're not an accredited university, but I've created a rigorous program that gets results for people, that helps them become professional traders in a very short time, not 4 years or 3 years or even 2 years, but we have a 90-day program using tried and tested, battle-tested strategies, which I developed while working at some of the largest financial institutions on this planet. And nowhere going to find anywhere the depth of the information, of the experience, of Elite Traders University. So I strongly consider looking at Elite Traders University to learn how to trade, to really learn how to trade, because there's nothing out there. And when you go to these 4-year degrees, or basically you'll go for masters another 2 years, you're going to learn theory, right? What could work, but not based on real time analysis or real time market conditions. So you're going to look at something that's historical. The time it comes out in a book, it's already old. And but my information and what I teach is based on real world experience from working for one of the largest banks, largest brokers, dealing with dealers, dealing with the structure, the beast, so to speak. And so that's kind of information you want. You want practical information. People are tired of ivory tower stuff that doesn't work. I'm spending $70,000, $80,000, $100,000 for a degree and getting into debt for it and not having anything to show for it and just saddle with a bunch of debt. And I know you're tired of that. And that's why I created Elite Traders University. So don't miss your opportunity to be able to work with me and work and actually become a profitable trader. Okay. So we talked about this. We're about the inflation rate year on year, preliminary 5.6, 5.9%. It looks like inflation is kind of like lowering a little bit because of the hiking in interest rates. So inflation is the I word, is the big thing everyone's focused on. And so anytime that you hear about it, you need to pay attention, because higher inflation in the U.S. is going to mean a stronger dollar, and everything else against the U.S. dollar is going to be much weaker. So the core inflation rate year on year for the Eurozone supposed to drop from 5.5% to 5.3%. And that may be bearish for the euro. Inflation rate month on month, the flash, MOM, is not mom. It's not your mom's inflation rate. It's your mom, right? Not your mom. It's month on month. And that's supposed to actually rise from negative 0.1 to 0.3. And it's going to be more volatile month over month, especially going back to school and maybe fall, maybe the storms. There's so many things that can happen month on month. comparing year on year gives a more smooth direction, a trending direction of where inflation is going. Unemployment rate supposed to remain steady, unchanged at 6.4%. Again, this is a Eurozone unemployment rate coming out at all these announcements are coming out at 5 a.m. So guess what? You're going to be looking at the euro. Now, I wouldn't advise trading the news on the exact, trading the news is really risky unless you have a good system like the Pip and Run system, which I developed. So I would advise maybe staying out of the market for 30 minutes to an hour and waiting for that news to pass, and then looking at getting involved in looking for opportunities to trade the euro. Okay, because this is where the party is going to be. If you're trading Canadian dollar, well, I love the Canadian dollar because it's my favorite. Well, trading your favorite currency, that's not a good strategy. You probably want to base it on what's going on in the economic calendar, because the news is like the wind, and the sales of these currencies, they have blows it across the water. It's the wind, and if there's no wind, there's no movement. So if there's no Canadian news, there might not be any movement in your Canadian dollar unless you're trading euro CAD, right? 8:30 a.m. We're back on their news cycle, the U.S. news cycle for that last day in August. We have personal spending month on month supposed to rise from 0.5% to 0.6%. And then personal income month on month is supposed to remain unchanged at 0.3%. Core PCE price index month on month is supposed to be unchanged at 0.2%. Core PCE price index year on year is supposed to increase from 4.1% to 4.2%. Initial jobless claims comes out Thursday as well, and they are supposed to rise from 230,000 to 235,000, and that might be actually bearish for the U.S. dollar. Remember, the Fed says they're data dependent, and the thing they're really watching is job creation and job growth. And so when more people are applying for jobless claims, that's they might more than likely not raise interest rates anymore. And then at 9:45 p.m., we're going to have the Caxton Manufacturing PMI. And PMI stands for Purchase Managing Index, doesn't stand for inflation, right? But if a manager doesn't want to purchase any goods, then probably the whole economy is slowing down. But if he's feeling really good and wants to purchase more stuff, that's a good sign that the economy is strong. So we're seeing a rise in China from 49.2 to 49.4, which could be very positive for the Australian dollar and New Zealand dollar. Okay, at 9:45 p.m. is something to look at. Friday, this is non-farm payroll day, but we're going to start off with at 2:30 a.m. with CPI out of Switzerland, the Consumer Price Index. We're looking at inflation rising from 106.2 to 106.3. Then we're going to have the HCOB Manufacturing PMI final out of Germany at 3:55 a.m., and that's going to increase from 38.8 to 39.1, could be impacting the euro. But remember, all these announcements in the face of non-farm payroll, the most widely watched news item on the economic calendar, watched all around the world. They said, well, why does China want to care about non-farm payroll? Why does Germany care about U.S. non-farm payroll? Why does Australia care about U.S. non-farm payroll? Because the U.S. is the number one economy on the planet, whether you like it or not. Go USA. And we buy stuff. 80% of our GDP is from consumerism. We buy stuff. We buy stuff from other countries because we don't manufacture very much here. And so we buy things from other countries. So when U.S. workers they're working, they have jobs, and they can buy things, it's good for other countries. And so that's why non-farm payroll is a big, big thing to watch. Now, in recent times, because of inflation, high non-farm payroll numbers has been bad for the stock market and has been bad for risk on assets, because the Fed will continue to hike rates until the non-farm payroll number starts to drop. When it starts to drop, that's probably when they'll stop hiking rates. So this is the case of when bad news becomes good news and good news becomes bad news. Okay. I know it doesn't make any sense. It's like crazy, Greg. I don't believe you. I don't believe you. I've been doing this for 30 years. This just happens, right? This is why 90% of all traders lose, because you think one way, a conventional way, which is not the way the market sees things, right? And when push comes to shove, your views are not going to win against the market's views, okay? In fact, we have something called the sentiment index in my market heat map. It shows where majority of people are positioned and their opinions about the market. And since 90% of all traders lose, we just do the opposite of what they do, right? In fact, the brokers I used to work at used to sell this information to big banks. Like, what are the retail traders doing? Well, they're buying this. Oh, we're going to sell this, right? They just do the opposite because the average person is wrong. So if you're not doing well in your trading and not making any money in your trading, chances are you're part of the 90%. Okay. If you're part of the 90%, if you're trying to get paid, the only way you're going to get paid is to get that money from the 90%. So you got to stop being the 90% and be the 10% who gets the money from the 90%. So if you have a car payment that needs to be paid, if you have a house note that needs to be paid, if you have a college bill that has to be paid, a phone bill that needs to be paid, maybe you want to take a vacation, that money is in the pockets of the 90%. And I can teach you how to get the money from the 90% by taking the right side of trades. So make sure you go to Elite Traders University and you can click the link in the description below and sign up for for our webinar, 4 Pillars to 6 Figures. That's the number 4 and pillars, and the number 2 and sixfigures.com, and attend our free masterclass so you can learn how we do things and see you could stop being the 10% or stop being the 90%, be the 10%, right? You want to be the 10%, right? All right. Remember, the 90% has the money you're looking for. Okay. With that, non-farm payroll comes up. And the drum roll, please. The unemployment rate is supposed to remain unchanged at 3.5%, which is not what the Fed wants. Non-farm payrolls are set to drop from 187,000 to 170. That's the forecast. Now, these guys get it wrong. They get paid a lot of money. They have lots of degrees. They have big computers, but they can get this number wrong. And if they are too wrong, the market can go really wacky, because if they're expecting 170,000, which means it's worse than the market's really pricing in a rally. They're pricing in some type of a risk-on rally of the stock market and things rallying, because guess what? The Fed sees, oh, wow, rate hikes are working. Fewer people have jobs. Let's boost everything up by lowering rates. So we're just going to lower rates, right? But what happens is this number comes in higher than expected. If it comes in at 300,000 or 225,000, then the market's, the Fed's going to come out saying, oh, wow, inflation's around the corner. We're not going to back down. We're going to hike rates. And then the whole stock market is going to probably collapse, right? So we're hoping for, if you are a stock trader, and most stock traders are long the market, they're long the stocks, traditionally, the markets continually go up, right? Then with pullbacks along the way. So most people are not going to be shorting or going back and forth or trading like this. So if you are a stock market bull, you want to see this number be very bad. You want to be like 110 or 150 or something, 120. Okay, if you're a stock market bull. But if you're a stock market bear, this thing breaks out at 300,000 and everyone has a job, right? What's good for Main Street is not good for Wall Street. We'll probably see more hikes, and the stock market will probably sell off on Friday. So very interesting. This number is going to be very, very critical. Mark my words. Respond back in the comments what you think about this. I know the truth hurts. Is like what Jack Nicholson says in the truth. You want the truth, you can't handle the truth, right? And most people can't. They think everything is lined up, and that's why we have people on the wrong side of the market. And the U.S. job market has been very, very resilient. Why? Because we have productivity, and the Fed doesn't get that if we can grow productivity uh, we won't have inflation, because what will happen is we'll have more people consuming things, and then we have more efficient production, which drives down costs. And if it drives down costs, that's why you're seeing these tech stocks actually rally. The big thing here is that in the past, when the interest rates go up, the Nasdaq sells off. It's selling off now, but it's seasonal now. We're in a cycle where the markets sell off. In the fall, August is like the worst month, right? For the markets, and then it rallies in September. Like October, November, we rally to Christmas, right? So this is just a cyclical. The pullback now is cyclical. It's not based on it. No, wow, these interest rates are high. Because ordinarily, when interest rates go high, tech sector sells off, and the tech sector didn't sell off. It's been rallying up until this recently, right? So we've had a tech rally in the face of high interest rates. Why? Because of AI, because of efficiency, because of worker efficiency, and being able to do more with less workers, right? And so now you have higher wages, but yes, we're working off some some of our excesses in supply and things like that. So it's a completely, we're trying to base it on 1980 Paul Volcker stuff from before many of you were even born, hyperinflation fears and stuff like that. But this is a different. We didn't have AI in 1980. We didn't have this technology. We barely had computers. So it's a completely different market. And so the Fed might it'll probably be seen that they've over tightened, and they're going to have to cut really aggressively in order to bring things back into alignment. And that should fuel a really huge rally in 2024. So I'm very optimistic. So people say, yeah, you're too optimistic, Greg. Yeah. Anyway, moving right along. Non-farm payroll, a blockbuster number could throw everything off. Average hourly earnings month on month is supposed to actually drop from 0.4% to 0.3%. That's another data piece that the Fed looks at, is average earnings. And they want you to earn less, because if you earn less, guess what? You can't buy as much. If you can't buy as much, supply and demand, no demand, less supply, price falls. Inflation solved, right? That's the plan. Remember the plan. Now you want to opt out of the plan and not be a statistic and do your patriotic duty by losing your job and making less money and working more. Well, then maybe I'll go to Elite Traders University and learn how to trade, and I can teach it so you can unplug from the matrix and not be part of their statistics. Okay, don't be a stat. Anyway, and here's your Canada data coming out. We have GDP growth annualized, supposed to drop from 3.1% to 1.2%. And with the fires and things going on, Canada growth has been hit, plus interest rate hikes has been dampening growth, which is what they want to happen, guys. This is actually according to plan. It's not conspiracy theory. They'll tell you. You watch Bloomberg News. You watch it long enough, they'll say, oh, well, I know it sounds kind of weird, but we really don't want the drop on regional highs. Like, did they just say it? Did they just say that? Like, no, you didn't hear that, Greg. That was a conspiracy. It's like, no, it's not a conspiracy. It's real. They just said it, right? No, you didn't hear that, Greg. Canada GDP growth month on month supposed to actually drop from 0.3 to negative 0.2. That's huge. I would look at shorting the Canadian dollar based on looking at this type of forecast. Again, forecasts can be completely wrong. The bean counters and these capitals, they get the numbers wrong. But if the market if it becomes worse than that, then we're going to see a huge sell off. A dollar CAD long looks very interesting just by looking at the data. 0.2% does GDP month on month to zero. Actually, that's an increase from negative 0.2% to zero. And here's GDP implicit. I'm sorry, I skipped down price quarter on quarter, a rise from 0.2 to 0.3. Okay. Then we have ISM manufacturing PMI as well. and this is going to be like it's going to rise from 46.4 to 47. That's the forecast. And that's it for the for what's going on for the economic calendar. So we're going to definitely look at the euro is going to be in play as usual, Aussie dollar and New Zealand dollar based on the Chinese data. And we also want to look at the Canadian dollar as well. But of all things we're going to be looking at is non-farm payroll and how it looks technically. Okay, so let's go to the technicals, and we can go to the technicals by we can go inside of my market heat map, right? There's charts, quotes, economic calendar, Forex TV, a financial news stream, market hours, technical analysis screener, national holidays, sentiment, and currency correlations, right? I actually like looking at sentiment. I'm going to show you a sentiment if I can get into sentiment, right? And if we look at sentiment, we can look at currencies, really, and let's see where, no, we're looking at the euro, for instance. Well, a lot of people are long Aussie dollars. So you say, oh my God, Greg, this is such a great part. I'm going to say, yeah, but don't buy the Australian dollar. This is a sentiment index. It's just you want the opposite. You want to do the opposite. The majority of the people are long, or 9% of people are wrong. So 70% of the people are long the Australian dollar, while 29.4% are short. Okay. Since losers pay winners, and it's like a pyramid, the bottom of the pyramid pays the top. Well, guess where it's fat? Right here, right? So we're looking for Australian dollar to drop versus the US dollar. And we can see that, the shorts are looking to get paid here. Here is where a lot of people are long the Canadian dollar. We affectionately call this the dumb money index, 65.0 and 35. So 65% of people are long and 35% are short. Well, losers pay winners, and there's more losers here than winners. So we do the opposite of what these people are doing, right? And we can look, here's the New Zealand dollar as well, and 69.87. The US dollar, a lot of people are short the dollar. Not very many people are long. Majority of them are short. And so this tells you right here that losers pay winners. The dollar is looking pretty strong here. But Greg, it's only 37.91 people. I want to be with the 62.09%. It's like, that's why 90% of all people are losing, right? It's the what's those guys, little animals that leap, lemmings. They all leap over the cliff together and jump to their death or something, right? Don't be a lemming, right? Cool. Okay. Anyway, let's get to the chart. To the charts. Okay. All right. And we're going to start with not this. It already looks like we do use dual time frame analysis, but we're going to look at this is what we were looking at here. All drawings. This is why I mark up for my mentorship class. We're going to monthly. We're going to go to the DXY. The DXY is the ticker symbol for the US dollar index. The US dollar index is a basket of currencies versus the US dollar. Kind of heavily weighted to the euro, but we can see on the monthly chart, we can see that we maybe remove all drawings. We have higher highs and higher lows. We look at a monthly chart to get a big wide view of what's going on in the market. You can see that, yes, the dollar has been going down, but yes, the dollar has also been going up, right? Higher lows and higher highs. Let me turn this magnet off. And right now, this current uptrend is taking precedence. As we see, we're making, after this, we bottomed out in the 100 area, and then the dollar came back off this wick on the monthly chart. We have the forming of a morning star pattern, a bullish reversal candlestick pattern. After this decline, this kind of pullback, we're kind of basing. We had a long wick candle called like a Pinocchio bar. Hey guys, hey, let's get short. All right, let's do it. Oh, stop. Oh, never listen to a wooden puppet. And there we go. So we got the Pinocchio bar right there. My students love when I do my Pinocchio voice, right? And then so we got a nice trend line break right there. And so I mean that tells you all you need to know, that the other currencies are going to get thrashed by the US dollar. On a monthly chart, we can drop it down to weekly chart. We can see stacking week after week after week of new highs. We just got a little bit of resistance coming in on this weekly chart, coming in at this level at the 104 area. We break that. We have lots of empty space to rally even higher, right? We're above the 200 simple moving average. And I recently talked on Thursday, our hour of power. We talked about the moving averages and how to use them, and how we use the 200 simple moving average to show bullishness or bearishness in the market. If we're above the 200, we look bullish, and if we're below the 200, we're bearish, and we're currently above the 200 on the weekly. And so that's a sign that we could continue to see more highs there. So bulls versus bears, we are bullish the US dollar. And especially if I break above 104.70, we could see maybe moves even higher back toward the old highs of 110, 112. Okay. Let's move on to the anti-dollar, the euro, EUR, USD. And we can look at our monthly chart as well, and also remove all drawings. I probably have a lot of stuff. And we can see that we're below the 200 simple moving average on the monthly chart. Below the 200, we did, and we can scope out. We can see that we had a little bit of a rally off this low around the 95 area, and we bounced, right? But now we're running into overhead resistance as this falling trend line barrels down across the top. And then we also had a rejection Pinocchio bar, where Pinocchio, I won't make the voice this time, but suckered in a lot of people into getting long the euro. And this is our bearish reversal bar, our bear trap, or bull trap, right? Because we had a range, and then price broke above the range and sucked people back into it, right? We do have a rising trend line that other traders may be looking at. That's why we saw in the sentiment that there are some people who want to get long, and maybe long and wrong, or maybe long for a short period of time. And we can see that we're 3 drives to a top, 1, 2, 3 drives. This is a bearish pattern. But Greg, it's going up. Yeah, but look how organized it is. That's like a march to jump off a cliff, right? So that 3 drives pattern is a very bearish pattern, and we look for price to even maybe come back and retag the low. So bulls versus bears, looking bearish here, bearish on the euro. Maybe short-term bullish, may have like a day or two of buying, and then a resumption of the downtrend. And we're sitting right at the 200 moving average on the daily. And this is demarcating the bulls from the bears right at the 200. And we break below the 200, we'll be in bear territory. We have almost like a head and shoulders. It's trying to get out of this range, and it's finding lots of overhead resistance, and now it's going to try going south. Bulls versus bears, I am bearish the euro. Let's go to GBP USD, and so we can move out to that monthly chart, and we can see remove all drawings, and we can see on this monthly chart that again, we're below the 200 simple moving average, a sign of the dollar dominance dominating the other currencies. And we can see this downward trend channel. Say that 5 times fast. Downward trend channel, downward trend channel, downward trend channel. Kind of hard to say, right? But here we go. And so we're hitting the top of that. I mean, the sellers came in so hard that they didn't even get to the top of the line. They're already turning down. There may be some hope, though, that this rising trend line will hold. but we're already cracking it as we speak, and we have maybe a bearish evening star pattern forming right here on the monthly. Drop it to a weekly. We can see that we're at the 200 moving average on the weekly chart. Again, if you want to join our Forex baby steps, to watch the replay of my webinar that we did on moving averages, the power of moving averages, how to use moving averages to your advantage to look at for trend direction. In this case, we're looking at as key levels of support and resistance to take low risk, high probability trades. You want to go to forexbabysteps.com and sign up for right now. It's we're having a $7 founders special, unlimited access for $7. After that, we're going to push it up to $27 a month, and basically the $1 a day. It's more than my Starbucks Doppio Espresso addiction. So it's but it's lots of packed full of value, lots of great content, actionable content, things that you can use in your trading, experience and knowledge that you desperately need in order to survive in the $6.1 trillion a day market. And we can see that right now, this 200 simple moving average is acting as a key level of resistance. Prices coming down, and we look for it for the pound dollar to continue its descent. As long as it can stay below the 1.3143 area, we could see moving on down like George and Wheezy backwards. We can see these levels of resistance or support coming into play, right? And if we break those, we can ultimately come back and retest. So this could be a 3, 4, 5 through those Elliott wave counters, something that we do in mentorship. Daily chart, we can see maybe we get a retest of the breakout point. We retest the trend line. And it'll give us an opportunity to sell at a higher price. If we can get back there, we could probably get and back there would probably be about the might not, let me adjust this line a little bit. We can. Yeah, we need to come back to like 127 and probably might not do that, may drop to the 200. Let's go to a 4-hour chart too, and you can see, you could see it's trying to turn a little bit, and we get maybe a little bit of a rally up before a drop. Pop and drop is, there's something to look at, but still bearish. The pound dollar and looking bearish, moving through the month of September as well, which is usually the pound is pretty weak during that time. Okay, let's look at the Aussie dollar, AUD, USD, basically our proxy for trading the Chinese economy. And we're going to start with a monthly chart, and we can see how bad, how this trend has turned down and heading back toward our pandemic lows. Our pandemic low is around the 54.79 area. And we're just barely holding on to support here. We have a morning star, which was looking promising as a rally back to an old high, but now sellers have come in and pushed price down as the dollar continues to gain strength, and also the combination of the Chinese economy stumbling due to we have what's going on with the commercial real estate. That's going on not in great shape, and you also have high unemployment among the youth, and also sanctions and things, of technology and things that the West has been keeping from China, have all contributed to the weakness in Australia. Okay, and then we look for maybe support coming in at 61.73. We had we're holding on to this 0 spot 6400 whole number, round number. We've been hanging around there for a while, and I'm thinking that we would get a break. Now we got a little indecision. We may do a little bit of a rally, it's like sniffing around if it wants to break and tag this and get down to this 61.73. And I would like to see this rally up from this area. And if we can get it, sell it high, and then hit it for a drop back down to the retest of the lows that we saw back here. And back here is our like October lows, and that's where I'm looking at price to hit 61.73. Bulls versus bears. I am bearish the Australian dollar. Short term bullish, like very short term, like a day or two, but then I look for a drop to this area. Okay. New Zealand dollar is probably about the same. I'm not going to go there for time's sake. What I want to do is go to the USD JPY. Always an interesting pair as it has our two risk off pairs. And we're making new highs, higher highs and higher lows with our monthly chart. And you can see that we broke and looks like we are heading on up, right? Higher highs and higher lows. The dollar is strong, the yen is weak, and so it's just a perfect match, like your chocolate and peanut butter, Reese's peanut butter cup here. We can see that we are working our way back after a steep decline and nice trend line break, and we're rallying back. Look who's coming back. Coming on back. 151.88. We should be there in a very short period of time. Daily chart, just small body candles, but still making headway. And might get any type of a pullback that might be worth looking at. We're also sitting at a key level of resistance. We could break that. And once we break that, we could see price open up toward this old high. Okay, bulls versus bears. I'm bullish dollar yen. Okay, dollar CAD. While with my eyes closed, not looking at chart, I am bullish this pair. Right, and we can see a big monthly candle U-turn. This is our 3 candle pattern. This is our morning star pattern. Huge, just simply huge. Right, boom. Right, bullish flag pattern, and we're looking at the old highs to come into play as it gives another shot back at the one spot 4653 area. Bulls versus bears. I am bullish dollar CAD, and they move all my stuff around. Yeah, so I am bullish. Okay. Weekly, you can see daily. Okay, and let's go and take a look at one of my favorite things to trade is gold. XAU USD, XAU USD, MOUSE. No, we're going to go out to the monthly chart and start from monthly analysis, move all drawings, and then come on down. And remember, when we're trading gold or trading anything, we're trading it unless you're trading a cross rate or some type of exotic pair, we're usually trading against the US dollar. So if the dollar is stronger, it would imply or mean that gold will be weaker. And we got as low as 1800 and 1897 or so, 1894. And you can see the long wick down there, 1879. We got even lower than that. We got my mistake. But we got the makings that it looks like a triple top, which I look at maybe a double top, a rise, and we see some type of a pullback, maybe down to the 1806 area. I'm bearish gold. We have a nice little head and shoulders pattern right there, which is pretty tasty on the weekly chart. That's what catches my eye right away. And I'm looking for a drop. Oh, okay. So we got bearish head and shoulders on gold on the weekly, on the daily. We can, we're getting a little bit of a rise, we can draw a trend line underneath that. And when we get the break of that trend line, it could be a good indication that the gold will continue to fall. Again, not a trade recommendation, but it is something I'm looking at. This is purely for educational purposes only. XAU USD, bulls versus bears. I am bearish. Okay. And let's go ahead and take a look at the, we're going to look at WTI, look at oil. US oil. Let's try that. Okay. Oil's well, the ends well, monthly chart, and remove all drawings. And we can see after hitting some lows in the $67 a barrel, we have come up dramatically. Oil is priced in US dollars. So again, you have a kind of a US dollar versus oil thing going on. Slowing economies, less demand for oil. OPEC is also thinking of slowing production or lowering production in order to maintain the price. A harami or spinning top with a bullish candle, a bearish. This is a bearish harami, and this looks bearish on the monthly, weekly. Maybe we just kind of like tapped, double top. Maybe we see a drop. Double top, don't stop till you drop, right? Lower time frame daily looks a little bit bullish. Big push up, pull back, and maybe a retest of 84 before dropping. So I wouldn't count this out. Bull versus bears. I am short-term bullish, maybe medium-term bullish. But up to about 84.12. And then we'll see if that holds or breaks. Okay. All right, let's go ahead and look at the NAS 100. I was talking to Cindy about that. And here we go, monthly chart. Cindy Norman, a great pool player. Big howdy do to you. Here we are, monthly chart. And you can see that while they were hiking rates, the NASDAQ continued to rise until we got up to this area here. And we're getting a little bit of a pullback, and, this maybe looks like it's providing a good buying opportunity to add more. But, the pullback pain here on this one candle. One candle a trend does not make. And we've had lots of uptrends with red candles and continuation, right? So this could just be a small pullback in a trend that we could see moves higher. Looking at the weekly chart, we can see that we are approaching this trend line, and we actually got a little bit of a reversal, trend line break, and we can see a bounce. So bulls versus bears, I'm bullish as 100. As long as we can hold that low. There's a low right there. A little swing low, a little morning star candlestick pattern. 14,552.56. And let's see if we can hold that trend line, and we can probably work our way back up to 15,927.7. Okay, let's look at the S&P 500, SPX 500. And have a similar pattern there where we broke the trend line, pulled back, monthly chart. It's just one big bearish engulfing candle. But again, one candle a trend does not make. I'm bullish S&P 500. In the long term, maybe for the short term, it may be bearish, but I think we get a short-term rise, medium-term drop, and then a longer-term rise. So ABC, right? So Yeah, because that's kind of, it looks corrective. It broke the trend line, so it might look like it might eke up a little bit higher, but then if it hits the back of that trend line, it could drop from there. Okay, so that's how I see it. If you have any comments or questions, you can enter them in the chat box below. Make sure you reach out to us at elitetradersuniversity.com. You can reach me at greg@elitetradersuniversity.com. You can also come over to get a free masterclass at elitetradersuniversity.com as well. And let me get rid of that. There's also a lot of other free resources you can have access to, including the Income Boost ebook blueprint. And also you can sign up for our weekly webinars on Thursday so you can learn more. This week, we're going to talk about compound day trading and how to create a compound trading plan. So make sure you join us. Make sure you follow me on Facebook and Instagram, also on Threads, and join our free Facebook group, as that's where we post when we're having those webinar events. And you can also, if you want trading, we're having a back to school special on our Forex Foundations Power Course. And it's the 8-week boot camp. And I look forward to being able to train you and teach you this wonderful method for extracting money out of the market on demand. Yeah, my name is Dr. Greg McLeod with Elite Traders University. Peace and pips. We'll talk to you soon. Bye-bye.
If you felt a spark here and want to see how these principles can be used in your own trading, go to www.elitetradersuniversity.com/apply to book a free session with our team. We have helped hundreds of people remove the frustration and obstacles in trading to become consistent, highly profitable traders. These are proven principles that just work. Happy pipping!